I am AI avatar of CA Ratan Mundra. This case is related to a regulatory order issued by the International Financial Services Centres Authority, commonly known as IFSCA. The order involves a company named Silver Stream Equities Private Limited, which is registered as a stockbroker under IFSCA regulations. The main issue in this case is the failure of the company to submit mandatory quarterly reports as required by the regulatory authority. These reports are very important because they help regulators monitor financial intermediaries and ensure compliance with market rules. However, in this situation, the company remained inactive for a long period and failed to fulfill its reporting obligations. Because of this non-compliance, the authority initiated regulatory action. This video will explain the full case step by step, including background, allegations, responses, findings, and final order. Understanding this case will help us learn how strict regulatory reporting requirements are in financial markets and what happens when companies fail to comply with them. This is not just a legal matter, but also a compliance lesson for all financial intermediaries operating under IFSC regulations. Silver Stream Equities Private Limited is a registered stockbroker operating under the International Financial Services Centre framework. The company holds a valid registration number issued in 2017, which allowed it to operate as a capital market intermediary. However, according to the records mentioned in the order, the company has been inactive for more than 8 years on the stock exchange. This means it was not actively participating in trading or financial operations for a long time. Even though the company remained registered, it was still bound by regulatory obligations. In financial regulation, inactivity does not automatically remove compliance responsibilities unless officially approved. This becomes a very important point in this case because the company assumed that inactivity might exempt it from reporting requirements. But legally, registration itself brings continuous obligations. Therefore, even inactive intermediaries must comply with reporting rules unless formally deregistered or exempted by the authority. The International Financial Services Centres Authority issued a circular in February 2024, which made it mandatory for all capital market intermediaries to submit quarterly reports. These reports must be submitted within 15 days after the end of every quarter. The purpose of this requirement is to maintain transparency, monitor financial activities, and ensure regulatory control over all registered entities. Even if a company is not actively trading, it still falls under the jurisdiction of IFSCA if it holds a valid registration. Therefore, submission of these reports is not optional but a compulsory compliance requirement. The company in this case was fully covered under this regulation, meaning it was legally required to submit reports on time. Failure to comply with this circular automatically leads to regulatory scrutiny and potential action. This shows how strict financial reporting systems are in regulated markets like IFSC. The main issue started when the company failed to submit its quarterly reports as required under the circular. Despite being a registered intermediary, it did not comply with the reporting timeline. Because of this, the regulatory authority took notice of the violation. A warning letter was also issued through the stock exchange to alert the company about its non-compliance. However, even after receiving the warning, the company continued to default and did not submit the required reports. This created a serious compliance concern for the authority. In regulatory frameworks, repeated non-compliance is treated more seriously than a single default because it shows negligence or lack of responsibility. As a result, the authority decided to initiate formal proceedings against the company to investigate the matter further and determine appropriate action. In January 2026, the authority issued a show cause notice to the company. A show cause notice is a formal legal document that asks an entity to explain why action should not be taken against them for violation of regulations. It is essentially the beginning of enforcement proceedings. The notice clearly mentioned that the company had failed to comply with the quarterly reporting requirements. It also cited relevant provisions under the IFSCA Act and SEBI regulations. The company was given an opportunity to submit its explanation and defend its position. This step ensures fairness in the regulatory process, giving the entity a chance to present its side before any penalty is imposed. The notice also warned that further action could be taken if the explanation was not satisfactory. In response to the show cause notice, the company submitted its explanation. It stated that it was not an active member of the exchange and therefore believed that reporting obligations were not applicable. The company also mentioned that it had applied for surrender of registration earlier and assumed it was no longer required to comply with reporting requirements. Additionally, it stated that it was not generating any revenue and was incurring losses, and therefore the lapses were procedural in nature. The company also denied receiving certain communication letters and claimed lack of awareness about the reporting circular. However, it did submit that all required reports had been filed later. This defense was primarily based on the argument of inactivity and misunderstanding of regulatory obligations. After reviewing the response, the authority carefully examined the facts and found that the company's claim was not valid. Although the company had applied for surrender of registration in 2021, the request was never processed or approved. This means the company remained a registered entity under regulatory supervision. Therefore, all compliance obligations continued to apply to it. The authority clearly observed that inactivity does not remove legal responsibility unless formally approved. As a result, the argument presented by the company was rejected. However, the authority also noted that the company had eventually submitted the required reports. This helped reduce the severity of the case as the non-compliance was eventually corrected, although late. After analyzing all submissions and evidence, the authority concluded that the company had indeed failed to comply with the quarterly reporting requirements on time. This was considered a clear violation of the regulatory circular. However, since the company eventually submitted the reports and had been inactive for a long period, the authority decided not to impose harsh penalties. Instead, it recognized that the violation was procedural in nature and did not cause major investor harm or financial loss. This shows that regulatory decisions are often balanced, taking into account both compliance failure and corrective action taken by the entity. The final decision was therefore focused more on corrective compliance rather than punishment. The final order issued by the authority directed the company to pay applicable late submission fees. These fees are calculated as per the regulatory circular governing delayed reporting. The order clearly stated that even though the company had corrected its compliance, it was still liable to pay penalties for the delay. The decision was issued under the powers granted by the IFSCA Act and related SEBI provisions. The order also mentioned that it would come into immediate effect. This means the company must comply without further delay. This step reinforces the importance of timely compliance in regulatory systems and ensures accountability even when violations are later corrected. In conclusion, this case highlights a very important lesson in financial regulation. Being inactive does not mean that a registered entity is exempt from compliance obligations. As long as a company remains registered, it must follow all regulatory requirements, including timely submission of reports. Failure to do so can result in penalties, even if there is no active business activity. This case also shows how regulatory authorities provide opportunities for explanation and correction before imposing penalties. However, compliance deadlines are strictly enforced. Therefore, every financial intermediary must ensure proper reporting discipline. This case serves as a reminder that regulatory compliance is not optional, but a continuous responsibility that must be maintained throughout the life cycle of registration. Moon Says and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within GIFT City in India, delivering end-to-end IFSC setup, operational support, and handling compliances, risk management. Renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university, BATF, and ancillary regulations, and fintech. Expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA, comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network. Scan the QR codes below to stay connected with us.